So obviously, guys, crazy week in the market. Big earnings, Microsoft, Google, Apple, Amazon. We heard from the Fed on Wednesday. We got the GDP report on Thursday. And lo and behold here, guys, the bulls have made some big progress this week. So I'll be the first one to raise my hand and say, hey, I'm wrong. As of right now, guys, I think the bear market for the short term is done and over with. I think that's the low. And I think maybe into, possibly into the next Fed meeting in September, starting to think the path of least resistance of the market is to the upside. So as far as the progress they've made, I think a pretty interesting observation. That dip on Tuesday to the daily 21 EMA, that was the first time, guys, we actually held that dip since August of last year. Take that into consideration. Since a year, we'll call it a year. It's been almost 12 months since the S&Ps have pulled back to the 21 EMA and actually held up. Fail. 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 Big fail. Big fail. Big fail. We're going all the way back to last year. So that alone is a change. Right? A little bit of structure holding. And then if we start going through some weekly charts in the market. Now keep in mind, with the S&Ps and the Qs, really for anything, in a weekly downtrend, which for now we're still in a weekly downtrend, your big level of resistance is going to be your weekly 21 EMA. So if we can actually get back above and hold above that weekly 21, it starts to kind of change the dynamics of the market, guys. So the S&Ps are kind of giving the weekly 21 a smooch. The QQQ runs up, gives that weekly 21 EMA a smooch. So it's not as if I think we're going to rip right through and just immediately rally higher. But it's a big level where, like a name like Amazon, for example, now you're well above the weekly 21. Now, we haven't been this far above the weekly 21 since last year. You've got names like Tesla. This should be week 2, closing back above the weekly 21. So not only have we repaired the daily structure, not only have we canceled out every single sell signal, now you're making improvements to your weekly structure. And then, of course, you got the Big Apple, not to be outdone, week 2 back above that weekly 21 EMA. So I don't think we're going to necessarily just rip from here. And of course, the daily charts are just a little bit extended right now up here at +2. So I do expect a dip, but based on some things improving weekly structure, based on a handful of different things we're seeing, I do think, guys, we're looking for that next pullback. We're looking for things to hold. And I think it's time to potentially get back to buying the dip. Another thing that has me, thinking, along these lines of, path of least resistance could be to the upside, is that we're kind of seeing this dynamic market-wide. This isn't exclusive to big tech. XLK's beast mode. Check out the weekly chart. Back above your weekly 21. It's not exclusive to XLK, because the semiconductors had made the same kind of progress. Clean up daily structure, cancel out every sell signal. We get some buy signals. We're working on getting back above the weekly 21. So you're seeing it in the semis. You're seeing it in technology. You're seeing it in the utility sector. The freaking Utes. Even the utilities look good. Healthcare. Very solid. XLP. Consumer staples. Really solid. And then our trade from this week, energy, which we took profits on this morning, even energy heating up. So the key, of course, guys, is going to be the back test. I think right now the S&Ps, the Qs, they're a good 2% or so above the hourly 21 EMA. So it's not sustainable strength in the short term. Expect at some point we're going to get the flush. That's the million-dollar question, though. Do these flushes start to behave a bit more like bullish trend? That's not bullish trend, right? That's just you trap your shorts, you squeeze the crap out of them, then you crush the bulls. Bear trap to bull trap. That's not bullish trend. Squeeze the shorts, trap the bulls, first back test fails miserably. That's been the theme since, pretty much since the year started. The dip to the daily 21 doesn't hold. Your dip to an hourly 21, that can barely hold as well. So let's not get giddy here, guys. Let's be disciplined, make sure we're picking our spots wisely. But that's my mindset right now. Based on shifts in trend, structure, momentum, based on improvements across a bunch of different time frames, based on the big three signals, getting rid of every sell signal and starting to go bullish, all kind of feels like we might be looking to buy that next dip. Back under the daily 21 EMA, I think we throw this idea out the window. But I say all this to say, focus on nothing else besides price action and structure. If you're dialing into the news, if you're on Twitter, you talk to people who don't even trade, right? I'm talking to more people as of late. I'm hearing folks are cleaning out their retirement accounts, they're taking their losses, they're shutting down everything. The news, the narrative, couldn't be any more bearish right now. Let us keep in mind, guys, the last time the market put in a bottom, back in March of 2020, let us not forget the news, the narrative, everything going on in the world could not have been more bearish during March, April, June, July of 2020. Price action and structure tells all. Back above the 21 EMA, first back test holds. Next leg to the upside. Back to the 21, back to the 21. We emerge from the dirt to quickly getting back to some bullish trend or some bullish properties. I'm not here to make the call that we're going back to all-time highs, and again, I'll be the first one to raise my hand and say, hey guys, we're clearly not ready to trend to the upside. But the point being, CNBC, Kramer, they ain't going to tell you, hey, time to get long. Price action will. The narrative will continue to be ugly. People are struggling to pay the bills, gas prices, recession, all that stuff. Just focus on trend, structure, momentum. For the first time since last year, we successfully held the dip to the 21 EMA. Where I think there could be some additional fuel to the fire is just the fact that it seems like so many folks are incredibly bearish. I think we got a lot of people in this market with the expectation that this has to fall apart. We're going to roll over, the market's going down, like just negative, negative, negative. If that's the narrative, that potentially makes this rally even stronger. If every time we flush, we get people buying puts, getting short, looking for the end of the world, that's where every flush could just simply be a bear trap that leads to a huge rip to the upside. You kind of got that feeling this week. Everyone looking for the bull trap, then the next leg to the downside. So anybody shorting that little pullback, they're getting squeezed out. That's where you get these crazy-ass 2 to 3 day rallies. So that is how I'm seeing things, guys. And that's not based on, my opinion of the U.S. economy, the global economy. It, quite frankly, has nothing to do with what the Fed says, because, frankly, I don't understand them or care to understand them. It's just the price action in front of us. We've totally improved daily down to the 5-minute structure. From the S&Ps to the Qs to the financials to healthcare to energy, we've rid ourselves of all the big three sell signals. So now from your indices to your sectors to your leading stocks, I actually can't find anything right now that tells me path of least resistance is still to the downside. Not even on a 5-minute chart. Then as these lower time frames start to go bullish, now on the S&Ps you have a 5-minute, 15-minute, 30-minute, 1-hour chart telling you, get long, buy the dip, trade the squeeze, path of least resistance to the upside. With all that being said though, expect a dip. This kind of push, while it's fun to play, not sustainable in the short term. So be cautious here, guys, in terms of loading up here. Because if we kind of put things into percentages, the S&Ps are up here at 410. The hourly 21's down there around 400. In other words, today, right now, the S&Ps could pull back by 2.5%. Like, just absolutely whack anybody buying calls up here. Our structure is still bullish. We'll still have our hourly buy signal. We'll still want to buy the dip. On a much smaller scale, same thing yesterday morning. We got that huge rip post-Fed. We get a little bit too stretched. Right? We're a little bit too far away from those 21 EMAs. You guys remember yesterday morning. Here comes the flush. The Qs are down 1.5%. The S&Ps are going red. People started to get a little bit panicky. Trend structure momentum, the big three signals told us clear as day. Nothing bearish about this. Oh, I deleted my 21 EMA. What am I doing? Hold on. Get back over here. There we go. Big three signals told us clear as day. Nothing bearish about that dip yesterday morning. A dip to a 21 EMA with a buy signal can't be bearish. Trend structure momentum says otherwise. So keep that dynamic in mind. We gapped down 2.5% on Monday. If it holds up there, I'm looking to buy that dip. Right? If you're getting long up here, nothing about that 2.5% pullback would feel bullish. Right? No part of you is going to think if you're getting long up here, yeah, let me buy more calls on this flush. So be disciplined, guys. Respect the ebbs and the flows of the market, but more importantly, just respect the changes in structure. It's incredibly easy, regardless of what's going on in the world, regardless of the macro view, regardless of the narrative. It's incredibly easy for the market to just continue to trend lower. When we're under with the weekly 21, when we're under the daily 21, and we have all these sell signals. So I'm not trying to read too much into the last 2 weeks of price action, but the last 2 weeks of price action have seen more progress in the bulls since the beginning of this year, since the downtrend started, basically. The ball is in their court. We'll see what they can do with it. But that's my view on things, guys. And then as far as trades on our end this week, we've only had 2 trades, which with it being kind of like the WrestleMania kind of week for the market, I'm okay with only a couple of trades. But in my mastery and then in the live trading that we're doing for the Big 3 class, we bought some energy calls this week. So in the mastery, we bought them on Monday. In the class, we bought them on Wednesday. And we flipped them out this morning. It's my classic textbook trade. Above the daily 21, lower time frames go bullish. We're getting some big 3 buy signals. That's all we need, guys. Because we're not at the point where we're working with bullish trend. Right? This is bullish trend. On a bigger scale, of course. We make a leg to the upside. We revert to the mean. We make a next leg to the upside. That's bullish trend. Like Valero from a few months ago, and maybe Valero soon. That's bullish trend. We got none of that right now. We don't need that. Find something trading at the daily 21 EMA. Then with the big 3 indicator, if your 5-minute, 15-minute, 30-minute can go bullish, that alone can trigger a move all the way up towards +2. Then keep in mind the risk-reward dynamic. In the mastery, we took home a 60% profit on this push. We weren't going to lose anywhere near 60%. Maybe we lose 10, 15, 20% because we're taking an entry nice and close to that daily 21. The exit would be a close back under the daily 21. Very little risk. Of course, it could always gap down, but very little risk. The reward is the push all the way towards +2. Last couple of weeks here, guys, that's how we're sneaking in with these lower time frames, catching these 60, 70, 80% returns. XLE. Coinbase was the same exact trade. Above the daily 21, 30-minute squeeze with our buy signals. That moment in time on the 30-minute chart took us all the way towards +2. That made for a good 80% in a couple of days. We even jumped into a 5-minute squeeze with the big 3 buy signal in the QQQ last week. Picked it up here, flipped it out at +2. Nice 80%. So understand that dynamic. You're trying to get in line with the ebbs and flows of the market. To buy calls on QQQ right now, it's a totally, totally different trade than buying calls on the QQQ back here. Up here at +2, there's this growing probability we got to pull back at the 21. You're not fighting that growing probability back here. So we had the XLE trade, guys. Took some profits in both rooms, waiting to buy the next dip, and then in the options room, we got some Oxy here. Same exact trade. Above the daily 21, 1 hour, 30 minute, 15, 5 minute charts go bullish on the big three. We're looking for a push up there towards +2. So that's what I'm seeing as far as the market goes. That's what I'm seeing as far as trade opportunities. The key is just pick your spots wisely. Pretty good chance. You had a lot of people buying calls today because they're feeling the FOMO, because their shorts didn't work. I'm not saying we have to pull back next week. Nor am I saying, guys, we have to continue to trade higher. This could roll over and be donezo. Point I'm trying to make is pick your spots wisely. When you're fighting that growing probability that we're going to pull back at the 21, it's a bit of a different trade. So that's my mentality for now. As long as these pullbacks to an hourly, a 30-minute, a daily 21 EMA, so long as they hold support and structure, I'm of the mindset right now, I'm aggressively looking to buy the dip. If I'm wrong, I'm wrong, and the good thing is, I'll know exactly where I'm wrong, and I'll know exactly when it's time to stop working that bullish game plan. But that's how I'm seeing it for now. Next round of pullbacks holds, looking to aggressively get long.
Hey, Focus Chain here with Simpler Trading. Thank you guys so much for watching this video. If you enjoyed it, please make sure you like, comment, subscribe, turn on notifications so you don't miss anything that we do. And if you want to see us trade our money live in real time, go to simplertrading.com and you can sign up for more. But happy trading, guys. Stay focused. I'll talk to you in the next video.